Hello and welcome to my YouTube channel, the Corcoran Codex. What I want to look at in this video is understanding bond pricing and also go on and look at duration risk. Let me deal quickly with the second issue. Now, let's suppose you buy a US Treasury bond. You assume that there is no credit risk, and let us hope that that remains the case. But what is possible, in fact, is actually happening a lot in the current marketplace, is that many US Treasury bonds, let's say that were issued during the COVID period, with very low coupon values on them, they only pay out maybe 1.25% of interest, and they last perhaps as long as 30 years. If you wanted to sell such a bond today, rather than hold it all the way through to maturity, you would find yourself losing perhaps as much as 1/2 of the face value or the par value of the bond. So what I have done in the earlier part of the video is to explain the basic pricing behavior for bonds. They are somewhat complex instruments, and I've also explained the calculation of the yield. I've covered issues related to duration, and that will actually help to explain why it is that, say, even credit risk-free treasury bonds actually entail quite a lot of market or duration risk. Now, let us get into some of the basic mathematics of how bonds are priced. And we can see on the screen, this is a discounted cash flow equation, essentially, in which the present value, or PV, or price effectively today, of a bond can be calculated. The first thing to notice is that there are these amounts, these numerator amounts here, C1, which essentially is the coupon for the first coupon. This is the second coupon, third, and then the final redemption amount of the bond when the principal is returned back to the investor. This we can call the face value, and this is paid on at the end of the bond's lifetime. Now, because all of these amounts are future cash flows, they're paid out in the future, we know from basic finance that we need to think in terms of present value issues. What is the value of cash received in the future in terms of what it's worth to us today? And we know, because there are opportunity cost issues around not being able to earn interest on the cash flow in the future, whereas we can if we have it now. There are also issues related to the diminishing purchasing power of future cash based on inflation and so on. So what we do is we discount all these future cash flows by a discount rate, which can be seen here. So essentially this coupon, let's say this is the first coupon, and maybe this bond pays out only once per year. Let's say this is a 5-year bond even, so we have C1, 2, 3, we don't see 4 and 5. This would be then the face value being redeemed at the end of the bond's lifetime in year 5. All of these amounts are then discounted by applying the formula on the screen. The denominator, which is 1 plus R, which is the discount rate we're going to use, and to keep life simple, let's just assume that that is a central bank policy rate. This CF here depends on whether this is once per year or twice per year. In this case, it is only once, so we don't really need to think about that. This is a continuous discounting function, so we need these exponents. 1, which doesn't make any difference, but year 2 and 3, 4, and 5, and so on. So once all these individual cash flow amounts have been discounted to present value, we can sum them, and this sum of all of those effectively is the PV, present value, price today of a particular bond. Now, when we come to thinking about bonds, one of the more critical aspects of their behavior has to do with their sensitivity to the changing interest rates. We just saw on the last screen that the value that we use in the denominator, that R value, the discount rate, and as I suggested, maybe we think about that as say, a central bank policy rate, that denominator, the discount rate, will of course affect the value of the bond. The higher the discount rate, the lower the present value of the bond, and vice versa. So one very useful and convenient piece of maths really related to bonds is what's known as the Macaulay duration, named after an academic. And here we can see the key idea behind this duration concept. So here we have a 5-year bond, let us say, and this is the payment of the first, second, third, fourth coupon once per year, as I indicated. And on the right side, we have the final coupon amount and the redemption amount that have been added together. Now, along this timeline, which is 5 years, let's say we have received all of these payments, and you can see we've actually taken into account the cash amount, future cash flows, as it were, and adjusted them for their present value in accordance with the last slide. Let's suppose we have received all of these amounts, and we still have to receive this amount on the right-hand side. Now, essentially, this pivot point or fulcrum here is where the sum of these amounts already received is equal to the sum of this amount yet to be paid. At the moment, we don't know what the size of the coupon is. We don't know what the discount rate is. But what we can say in general terms is that the normal duration of, in fact, this 5-year bond will occur sometime here between years 4 and 5. And Macaulay duration is actually measured in years. It is a metric which is expressed in years. Let us turn to what is actually a very easy and quick way of thinking about the sensitivity of bonds to changing discount rates. So let me go through what we have on the screen. A bond which is currently priced at par, so let's suppose it's a US dollar bond, so it's priced at $100, yielding 7%, has a duration of 4.5 years, what we just saw on the last slide. This is the Macaulay duration, and it amounts to 4.5 years. And the question which banks, asset managers, investors face really almost on a daily basis is, what would the new price of the bond be if the yield was to fall to 6%? In other words, we can also think in terms of the discount rate changing from 7 to 6%. There is a very simple formula at the top here, and let me go through it. So it says the delta of the price, delta means many things in finance, in this case it simply means the change, is equal to the negative sign, notice, modified duration, multiplied by the change in the yields, which we've just been informed is down 1%, multiplied by the original or current price, which we've also been told is $100. So we have almost everything we need to plug into this formula, but we need to consider modified duration. Modified duration is simply the Macaulay duration of 4.5 divided by 1 plus the yield to maturity, the current yield to maturity, which is 7%. That simple maths resolves to 4.2. And what we can do now is plug those values into the formula, and we can see that the delta in the price is equal to negative 4.2 multiplied by a 1% fall in yield multiplied by $100, the par amount, and it comes to $4.20. Now, one thing that should be immediately obvious is that the change in the dollar value of $4.20, or in fact 4.2% really, is exactly in line with the modified duration metric, which is in fact 4.2. So obviously the new price of the bond is the old price, 100 plus the 420, 104 spot 20. Now, 2 or 3 things to notice right away. The first one is the yield has come down by 1%, but the price has gone up. And this highlights the inverse relationship between price and yield. They move in opposite directions. And in terms of the formula, that is captured by using this negative sign here. So, for example, we use the negative, we multiply that by the change in the yield, which is also a negative. Simple math tells us that one negative multiplied by another leads to a positive. So let us suppose the yield had gone up by 1%. This would not have that sign. This would. We multiply that out, and this sign would then be a negative. Now, there are many other interesting features of the behavior of bonds. All I will say here with regard to this simple formula is that it is a quick back-of-the-envelope method for measuring the sensitivity of the bond price to changing yields or discount rates. And in fact, in the real world, there is only a very limited sense in which it provides an accurate answer. In most cases, we would need to do a full-blown discounted cash flow analysis to determine the exact or precise change in the price for a change, let's say, in the yield or discount rate. There's one other very key feature of the behavior of bonds, which relates to, again, the more complex relationship between price and yield. So let us suppose for one moment that the price-yield relationship was simple and can be expressed in a simple linear fashion by this red dotted line. So here we have the price axis, here we have the yield, we have a bond which is currently yielding whatever that number is and priced at this amount here. Now let us suppose that we were going to reduce the yield, let's say down to Y1, and we were to extend up to the red dotted line and read across on the price axis. We may then believe that the new price would be P1. But in fact, that is not the case, because the relationship between price and yield does not follow this simple red dotted line. Modified duration does, but that in itself, as I've said earlier, only gives us an approximation to correct pricing. We actually need to extend this dotted line all the way up to this blue curve, or what is known as convexity. And then once we reach this blue curve, read across, that does give us the correct new price of the bond if in fact the yield was to go down from there to there. Exactly the same logic applies on the other side. If the yield goes up, we also need to extend up to the blue line and read across. So what we're seeing illustrated here is that the price yield behavior is not simple and linear. It has this feature of curvature or convexity. What we can say in general terms about the sensitivity of bonds to changing yields or discount rates is captured on this diagram. First of all, if we look at the maturity or lifetime of bonds, those with short lifetimes, relatively speaking, will be less sensitive in terms of their price change for changes in interest rates than those bonds which have long lifetimes, relatively speaking. And also, those bonds which have relatively high coupons will be less sensitive to changing rates than those which have low coupons, relatively speaking. That can all of that can really be thought of in terms of the diagram I showed earlier on, 2 or 3 slides back, when I was showing you that break-even idea in terms of how long the Macaulay duration is. And clearly bonds which have high coupons are going to break even sooner in relative terms than those with low coupons. Now, what I want to discuss now, I'm going to turn to Excel and go through this within an Excel workbook. So I've now switched to an Excel workbook entitled Fixed Income Calculation Basics, and I want to explain the model that you can see on the screen. What I have created essentially is a model which can be used to explain some of the concepts and terms I've used already. This model is for a 5-year bond. It is a dollar-based bond, so we can even think of this as a US Treasury note. The US call any bonds of 10 years or less notes, and then beyond that they call them Treasury bonds. So this has a par value, face value of $100, as can be seen here. And this is a 5-year bond, as I mentioned. It pays out twice per year. The coupon is paid semi-annually. This particular bond has a 4% coupon on it. And let us imagine the following, that the US Treasury has recently auctioned this bond with the 4% coupon, because that was, if you wish, the prevailing rate or yield on 5-year notes at the time. So it would be normal for the Treasury to put a coupon of 4% on it. And if the bond goes out effectively in the auction where the bids are going to be close to $100, effectively the yield to maturity is 4%, the same as the coupon value. That is typically how those Treasury auctions would be conducted. So let us now go through the cash flow analysis for this bond. Here we can see the various periods extending down to 10, and the final payment here in year 5. This is the second half, if you like, of year 5. What I've done is combine half of the 4%, i.e. the coupon amount, plus the redemption of the par value of 100. So we can see that number here. So working our way down, this is time 0. This is when, say, the bond is going to be purchased, and the cash flow, of course, then would be negative. You'd have to pay $100 to buy the bond. After 6 months, you would receive half of the 4%, $2. $2 likewise, and I've already mentioned that we combine the face value redemption plus the final coupon at the bottom. Now, those are all the future cash flows that I mentioned earlier on, and we know that we must discount these future cash flow amounts to a present value. And there is the simple formula for that. This has been shown elsewhere. And we're going to use the 4% yield, the current yield 4%, as the discount rate. It just makes the logic easier to follow. It would probably not be a very dissimilar amount anyway if we used another discount rate, but 4% is quite convenient. So we are discounting all these cash flows here by the discount rate of 4%. And as discussed, we sum those discounted cash flows and we see the number of $100. Now, that should not be surprising given the fact this bond was just recently auctioned. It was priced to yield 4%, and because it has a 4% coupon on it, and it has a par value of $100. Now, of course, over time, the discount rate, the yield rate effectively, will change. Let us just imagine the following, that soon after this bond was issued, the US Treasury decides that it has to put a 5% coupon on 5-year notes from then on. Maybe the central bank, the Fed, has hiked short-term rates, and in line with the higher short-term rates, the market rates, say for 5-year notes, have now gone to a 5% yield, and the Treasury puts a 5% coupon on the new issue, not that far down the road from when this bond was auctioned. So let's consider now what happens to this bond, which only has a 4% coupon, if it needs to be priced to yield 5%. Notice the language carefully that I use there. What we're looking at is what is the price that this bond must trade at in order to yield 5%. So let me then put the number 5% in there. And as can be seen, the price would go down. The yield has gone up by 1%. The price goes to 95.62. And here's the good way to think about this inverse relationship between price and yield. Let's imagine two people who've approached me now with a view to selling me a 5-year note. This person here bought this note with a 4% coupon on it not so long ago. They paid $100, basically the price that came out of the auction, $100, and it has a 4% coupon on it. And they come to me and they say, Clive, we would like you to buy this bond. We want to raise some cash, whatever, and we're going to charge you $100 for it because that's what they paid for the bond. And then I'm approached by somebody else who's just bought the more recently issued bond with a 5% coupon on it. And they say to me, I would like you to buy this bond, Clive. It has a 5% coupon on it for 5 years. It's a US Treasury note, there's no credit risk, etc., etc., and I would like $100. That's what I paid for it recently. Now, it's obvious that I'm going to choose this bond, the 5% bond, because over the 5 years, I'm going to receive 1% in additional coupon income than I would if I bought the 4% bond. So the person who has approached me to sell me this bond, the 4% coupon bond, goes away and does some calculations, does a cash flow analysis, and comes back to me sometime later and says, Clive, I understand why you would prefer to buy the 5% bond for 100, but if I adjust my price down to 95.62, and if you do the discounted cash flow analysis, you'll find out that you'll be in exactly the same place in terms of your overall return as if you bought the 5% bond for $100. That, in essence, helps to explain why the price and the yield do move in different directions. We can also see here, for example, how the duration is calculated. We calculate the Macaulay duration. We can go on and see how the modified duration is calculated. And we can see we have this number here of 4.45. Let me return this to the 4%, which is the starting point. And we actually see now that with the original 4% bond, the modified duration is 4.49 years. Now, you remember when I was discussing the convexity issue, the calculation of convexity, there was a point on that diagram, which essentially was the tangent point where the red dotted line met the blue curve. And I said at that time, that is the point when the modified duration will give a more or less exact price for a bond. And we can see that because what I'm about to explain next will illustrate the way that the modified duration is useful in that regard and only that regard, but it also has value as an approximation tool. So what I want to discuss now is known as the BPV of this bond, or any bond for that matter, the basis point value. And what that means is what will be the change in the price of a bond, this bond, if we were to increase or decrease the yield and, in a way, the discount rate by 1 basis point in either direction. As you can see, I've done that over here. So I've taken the 4%, I've added 1 basis point here, subtracted 1 here. I've done the full discounted cash flow analysis as I did here before. And in the case of a 1 basis point increase in the yield or discount rate, price goes down by roughly 4.5 cents. And in the case of a decrease in the yield by 1 basis point, the price goes up, and also by roughly 4.5 cents. If we take the midpoint of those, we have this number here, 0.04491, roughly 4.5 cents, which in fact is 1/100th of the modified duration. Now that actually is the only example where we could use modified duration to give us a precise answer. For any other change in the yield or discount rate, there is a necessity to do a full-blown discounted cash flow analysis. The final thing that I want to illustrate with regard to fixed income securities, bonds, relates to the US Treasury market. And what I have done here is to take this data from the Wall Street Journal. This is a subscription-based page available on the Wall Street Journal website. You can see the date here in June 2026. And what the WSJ provides on a day-to-day basis are the closing prices, effectively, for all outstanding US Treasury bonds. You can see here, this column here, the first column is the maturity. So this will tell us when this particular bond or the bond in question matures. We can see what the coupon was at the time the bond was issued in the auction. We can see the current bid and the ask in the Treasury market as of that day. This reflects the change in the price. And over here, this is the critical column, really. This is what is known as the asked yield. The best way to think about pricing of bonds, Treasury bonds being no exception, is to think that they need to be priced based on the coupon to yield what is shown in this column here. Now, well, what actually is shown in this column here? Well, maybe the best way to illustrate that is by taking an example. Let us say we take this particular bond here. Now, this bond will mature on the 15th of May 2040. It has a coupon of 1.125 or 1 1/8%. You can see the bid and the ask. And we can see the price would be basically in this sort of $63 range, is based on what would be the price for this bond with that low coupon in order to yield 4.75%. Now, why that number? Well, that number represents what a 15-year bond, if we take 14-year bond to be more precise, if we take where we are in 26, this still has essentially 14 years left to run. And the way pricing works in the Treasury market, it's based on the residual maturity and then comparing that, let's say, with a more current on-the-run Treasury note of, let's say, 15 years. And that the yield on that would be 4.75%. So the key point to take away, of course, is that this bond trades considerably below par. If one wanted to sell it, had to sell it on that day, not hold the bond right the way through to maturity, one would realize a loss of around 37 cents on the dollar, $37 off the par level. By contrast, we can take this bond. Now, this bond actually has a much higher coupon on it. This actually would have been a 30-year bond issued back in 2010, and that bond would have had a 4 3/8% coupon on it, much closer to this asked yield. And as can be seen, the bid and the ask suggest that the pricing on this bond would have been close to $96.25, which would again be at a slight discount to the par, but nowhere near to the same extent as this bond or that bond, both again very similar. Let's say we take this bond, which matures on the 15th of May 2050, which is roughly 24 years from this date here. And that bond also had a very low coupon on it. It was issued during the beginning of the COVID period when rates were very close to zero, and even coupons that were attached to long-term bonds were low. This was 1.25%. And as can be seen, again, this bond, if it needs to be priced to yield that amount, 5%, just over, then the pricing on that would be somewhere in the region of $47. So if you weren't going to hold that through to maturity and you needed or wanted to sell that bond on that date, you would have realized a loss of more than 50% of the par value of the bond. So I hope very much that you enjoyed that video and found it interesting and useful. If you find this type of material to be of value to you, where I analyze critical ideas and episodes in the world of global finance, could I strongly suggest that you decide to subscribe to this channel. Thanks very much for watching.